Silver's price is lying right now, and the spread is telling the truth. The headline number looks like a clean, cinematic melt-up, the kind that makes people either pound the table or roll their eyes. But under that headline, the plumbing is doing something that usually shows up right before the crowd finally understands what's happening. And the conflict is obvious. The responsible narrative says this is unsustainable, a classic silver spike that fades as fast as it arrived, while the tape is whispering a different story, one where the market isn't just excited, it's cornered by mechanics. Stick with me, because later I'm going to give you the exact near-term checklist for the next week, the levels that matter, and the one tell that separates a normal pullback from a pullback that loads the slingshot. And that's where the real pressure starts. Let's put the moment in context without turning this into a sleepy history lesson. Silver has been acting like silver, violent, fast, disrespectful, and totally capable of ripping your face off in both directions. We've just watched it go ballistic. After a monster year, January has been a straight-up sprint, with mainstream outlets talking about triple-digit prints and the market flirting with the $100 handle. Depending on the feed you're watching, you've seen mid-90s, you've seen high 90s, you've seen the kind of daily ranges that make risk managers reach for the antacids. One widely cited snapshot had it around the mid-90s, even as the $100 this week. Chatter got loud, and other market data services showed late January trading pushing up toward the upper 90s after sharp whipsaws. The exact print matters less than the behavior. Big up days, sudden air pockets, then bids showing back up like the market can't stay away. But that's not the part that matters. The part that matters is what that behavior forces participants to do, because silver is not a belief market when it's moving like this. It's a margin and hedging market. Here's why the loudest voices are dismissing it. After a vertical move, skepticism is the socially acceptable posture. It sounds smart. It sounds safe. This is a blow off top. This is retail froth. Silver always does this. And yes, silver does have a long, proud tradition of punishing anyone who confuses momentum with certainty. But the skeptics are usually looking at the wrong battlefield. They're staring at the candle and ignoring the curve. They were arguing about whether the move is justified while the actual market has shifted into a mode where justification is irrelevant. Because when you're near a psychological number like $100 and the market is loaded with options exposure and liquidity is thinner than people think, the move stops being an opinion and starts being math. And if this one level breaks, the math changes. Now for the hidden detail, the one most people miss, because it doesn't show up in a cute chart screenshot. This week isn't just another week. It's a calendar week, month-end positioning, options exposure rolling around, dealers managing books into a period where flows can hit the tape and stay there because there isn't enough resting liquidity to absorb them cleanly. And layered on top of that, you've got macro event risk right in the window. Markets are staring at central bank expectations, rate paths, and the kind of policy messaging that can jolt the dollar and real rates in a heartbeat. If you're the kind of investor who thinks fundamentals move the price first and derivatives react later, silver is about to teach you the opposite lesson. Because the derivatives complex can grab the steering wheel for a week or two, and fundamentals show up as the justification afterward. That's the trick. But the next detail is what flips the whole setup. Let's talk about the mechanism in plain English. Dealer hedging, delta, gamma, the stuff people love to hand wave until it rips their portfolio apart. When traders buy a lot of upside calls near a big strike, think round numbers, think $100, dealers often take the other side. Dealers aren't bullish or bearish. They're running a book. And when they sell you a call, they inherit a risk. If price goes up, the call becomes more sensitive to price and their exposure grows. To stay neutral, they hedge. They buy futures or underlying exposure as price rises. That's delta hedging. Now here's gamma, the rate at which that delta changes as price moves. Near the strike, gamma can get spicy. If you have a pile of calls concentrated around a level and price pushes into it, dealers can be forced to buy more and more as it rises. Not because they want to, but because they have to. That buying can feed the move, which pulls more momentum traders in, which forces more hedging, which creates a feedback loop. Not a conspiracy, a reflex. And once that reflex starts, the market can move faster than your brain can update its narrative. Because if this one level breaks, the math changes. Now add silver's personality to that equation. Silver is a smaller market than gold. It's higher beta. It's more sensitive to liquidity pockets. It can gap. It can overshoot. It can slap you for assuming the path will be smooth. And that's exactly why a gamma-driven push can feel like an explosion. It's not just enthusiasm. It's forced behavior. A dealer hedging program doesn't care about your feelings. It cares about exposure. And when exposure clusters around a psychological magnet, the market becomes a pinball machine. But that's still not the whole story, because the curve is where the truth leaks out. Here's what I mean by the spread is telling the truth. In metals, you don't just watch spot. You watch the term structure. How near-month contracts trade versus later months. In a calm, well-supplied market, the curve often carries a gentle carry structure. Storage costs, financing costs, normal inventory behavior. But when the front end tightens, when nearby metal is valued more urgently than metal in the future, you can see the curve compress or invert. Sometimes that shows up as backwardation, sometimes as an unusually firm front month relative to deferred months, sometimes as spreads that behave like the market is paying a premium for immediacy. That's the market whispering, I need it now, or at least, I'm not confident I can get it later without paying up. And when that whisper lines up with options exposure around a big round number, you've got two different forces pushing in the same direction. And that's where the real pressure starts. Now let's address the physical versus paper tension without turning this into internet fan fiction. Physical tightness doesn't always announce itself as no silver exists. It's more subtle. It shows up as premiums that don't fall even when price dips. It shows up as delivery windows that get weird. It shows up as certain sizes or forms being hard to source quickly without paying extra. It shows up as participants doing things that look irrational, like preferring nearer exposure or refusing to roll forward the way they normally would, because their priority isn't mark-to-market, it's access. If you've been watching commentary lately, you've seen people point out unusual behavior in how positions appear to roll across months, with attention on whether demand is being pulled forward. The key takeaway isn't any single headline. It's the idea that timing preference can shift. And when timing preference shifts in a commodity with both monetary and industrial demand, the market can feel like it's vetoing the paper story. But that's not the part that matters. The part that matters is what that timing preference forces shorts, dealers, and inventory holders to do. Let's keep it concrete. Futures markets are built around the concept that most participants don't want delivery. They want exposure. So they roll, usually forward, a smooth conveyor belt. But if, for any reason, a meaningful set of participants prefers nearer contracts, or even refuses to roll in the normal way, it can tighten the front end and amplify volatility. Now layer in the reality of inventory categories. In warehouse-reported data, not all inventory is the same. Some is deliverable against the contract. Some is simply sitting there, owned by someone who has no intention of delivering unless the price incentive becomes too strong to ignore. The market can print a big inventory number and still feel tight if the deliverable portion is constrained or if conversion requires a decision and a price. So when people cite inventory as a debunking tool, the right response is, which inventory, and what would force it to come out? Because the market doesn't care about the existence of metal. It cares about the availability of metal at the margin, right when it's needed, under contract terms. And that's where the real pressure starts. Now bring in the institutional flow layer, because this is where retail investors either get clarity or get trapped. A lot of people think ETFs and trusts are clean exposure. In calm periods, they can be. In stressed periods, they can become transmission lines. When demand surges into a silver vehicle, the creation mechanism can require sourcing physical or sourcing exposure, depending on structure, and it can interact with the underlying market in ways that aren't obvious from the chart. Sometimes you'll see a vehicle look like it's simply tracking. Other times, you'll see premiums, discounts, or changes that hint at a strain in the system. The important point is not to worship the wrapper. The wrapper is a pipeline. Pipelines matter when pressure rises, and right now, pressure is rising. At the same time, there's a fundamental layer that's not going away. Industrial demand. A lot of mainstream commentary has highlighted the shift toward heavier industrial usage. Electronics, solar, EVs, the build-out of data centers, the electrify everything theme that keeps swallowing metals. And unlike some commodity stories, silver has a supply reality that doesn't respond instantly to price. Why? Because a meaningful portion of silver production is byproduct. It comes out of mining for other metals. That means you can just snap your fingers and ramp silver supply because the silver price is hot. Lead times are real. CapEx cycles are real. Permitting is real. If demand is pulling and supply can't surge on command, price becomes the balancing mechanism. That's not hype. That's basic commodity math. But the next detail is what flips the whole setup. When the market is already tight at the margin, and then derivatives reflexivity kicks in, you get a move that feels like it's skipped steps. Now let's talk positioning and margin, the unsexy engine behind the most dramatic squeezes. In a big move, the first phase is discretionary buying. People decide they want in. The second phase is mechanical buying. People are forced in. Shorts cover because their risk limits explode. Funds de-risk because volatility spikes and their VAR models tell them to cut. Dealers hedge because exposure changes. Then comes the ugliest phase, liquidation. Not because the thesis is wrong, but because the market's speed breaks the weakest balance sheets. That's why silver can dump hard even in a bull thesis. Margin requirements can rise. Financing costs bite. A few big down candles can trigger stop losses and forced selling that have nothing to do with fundamentals. And then, if the underlying pressure is still there, the bids reappear and the move resumes. This is why you can be directionally right and still get wrecked. And that's the trap most people fall into. They confuse a violent pullback with invalidation. Sometimes it's invalidation, sometimes it's the reload. And the tape tells you which, because if this one level breaks, the math changes. Now, here's where we bring in a proof stack. Layers, not just one argument, because trust comes from redundancy. Layer 1, the chart behavior itself. Vertical advances, heavy ranges, quick recoveries after dips, classic signs of a market where participation is being forced, not just chosen. Layer 2, the round number magnet. $100 is not magical, but it is where strikes cluster, where headlines cluster, where risk committees cluster. That clustering matters. Layer 3, the curve and spreads. Watch how the front end behaves versus deferred months when price dips. If the curve stays tight even during pullbacks, it's often a sign the market still values immediacy. Layer 4, institutional positioning data. Public reports on futures and options positioning show how different categories are exposed, and whether non-commercials are loaded, whether commercials are offset, and how concentrated positions can be. That doesn't tell you direction by itself, but it tells you where pain could appear. Layer 5, the real-world symptom layer, premiums, availability, behavior around delivery windows, and rolling patterns. You don't need perfect data to notice if the market's comfort disappears. Layer 6, the macro regime. The dollar, real rates, and geopolitical uncertainty can all change the appetite for precious metals, and this month has had plenty of reasons for investors to reach for hedges. None of those layers alone guarantees anything. Together, they explain why $100 isn't just a meme. It's a level where multiple systems collide, and that's where the real pressure starts. Now, let's be honest and do the counterpoint first, because you don't build trust by pretending volatility doesn't exist. Silver can absolutely put in a savage pullback right here. After a run like this, a 10-20% drawdown is not just possible, it's normal. It could happen fast. It could happen on no news. It could happen overnight in thinner liquidity or around a macro headline that whips the dollar. If you're thinking, okay, but if it's going to $100, why would it pull back? You're thinking like a human, not like a market. Markets don't move in straight lines. Markets move in liquidity waves. They overshoot, they mean revert, they punish late entries, and then they continue. So if you need a fantasy where price floats gently upward on a cloud, silver is not your asset. But that's not the part that matters. The part that matters is how the pullback behaves. Because there is a huge difference between a pullback that breaks the setup and a pullback that strengthens it. A setup pullback looks like this. Price drops, headlines declare the party over, but the curve doesn't relax much. Spreads don't suddenly scream oversupply, and dips get bought with urgency. You'll often see sharp down candles followed by immediate stabilization, as if the market refuses to stay down. In contrast, an invalidating pullback looks like this. The market loses key shelves, bounces are weak, the curve relaxes meaningfully, and the tape turns from forced buying to nobody wants to catch this. Well, you don't need an economist for that. You need a checklist and the discipline to follow it, and that's where the real pressure starts. So let's name the levels without fake precision. In this kind of market, clean technical levels are less about art and more about crowd behavior. The mid to high 90s zone is the battle area because it asks the launch pad toward $100, and also the region where a lot of late momentum entered. $100 is the magnet and the headline trigger. Under that, you've got psychological shelves like $90, where a lot of people mentally anchor value after a spike, and where a retest can act as either a launch pad or a warning. If silver can't hold a retest and starts closing weakly below those psychological shelves, the market can shift from squeeze dynamics into liquidation dynamics. If it holds and recovers quickly, that's often the market telling you there's still forced demand under the hood, because if this one level breaks, the math changes. Now let's zoom out for 1 minute to the global arbitrage angle, because it matters more than people realize. Commodities are global, but frictions are real. Shipping, refining, vaulting, insurance, financing, those are not abstract. If there's a region where physical is bid aggressively and another where the paper price is lagging, arbitrage participants have an incentive to bridge the gap. That bridging can pull prices together, but it doesn't happen frictionlessly. When volatility is high, frictions widen. And when frictions widen, price dislocations can get bigger before they snap back. That snapping can look like a sudden surge in the headline price, when in reality, it's the global system rebalancing under stress. That's why watching just one chart can be misleading. The market is a network, and networks under strain behave non-linearly. But that's not the part that matters. The part that matters is what the strain forces participants to do next. Now let's tie in the macro driver layer without turning this into a political rant. Precious metals don't need one perfect catalyst. They thrive on uncertainty and regime wobble. When investors believe real rates may fall, or that policy may pivot, or that currency stress is rising, gold tends to move first, and silver can follow, sometimes with leverage-like behavior. In periods of geopolitical tension, trade policy uncertainty, and shifting expectations about central bank paths, hedging demand can become more urgent. And when silver already has industrial demand embedded in the story, that hedge demand can stack on top of real consumption narratives. That stacking is powerful because it creates two different buyer types. The I need silver for a process buyer, and the I need silver as a hedge buyer. When both show up, price becomes the gatekeeper. And in thin liquidity weeks, price can move far to find the level where someone finally says, fine, I'll sell. And that's where the real pressure starts. Okay, roadmap time. From here, it's basically two paths, and you should hold them in your head at the same time so you don't get emotionally hijacked. Scenario 1 is the controlled pullback and retest. Price spikes, fails to cleanly punch through $100 pulls back into the low to mid 90s, or even toward that $90 psychological shelf. Sentiment flips from euphoria to doom, and then the market either stabilizes and grinds back up, or it bounces sharply as forced participants step in. In this scenario, your confirmation isn't a green candle. Your confirmation is behavior. Are dips being bought quickly? Do spreads stay firm? Does the curve refuse to relax? Do moves down feel like liquidation that gets absorbed rather than selling that cascades? Your invalidation in this scenario is sustained weakness, repeated failures to reclaim shelves, bounces that look tired, a curve that relaxes, and a vibe shift from tight to loose. Scenario 2 is the continuation squeeze and gap risk. Price consolidates briefly, then pushes through the $100 magnet with momentum dealers hedge harder because the strikes flip from theoretical to in-the-money shorts scramble, and the market prints the kind of candles that make people swear off trading for life. In this scenario, the risk is not being wrong. The risk is volatility, gaps, slippage, emotional decisions. Your confirmation is that the breakout holds above $100 rather than instantly reverting. Your warning sign is a fast rejection that traps breakout buyers and flips the move into a vacuum drop. Because if this one level breaks, the math changes. Now, I want to build your viewer psychology shield because this is where most smart people lose. The market will try to manipulate you with volatility. It will do it in two main ways. First, it will use upside velocity to trigger FOMO, making you feel like you are missing the move of your lifetime, unless you act now at the worst possible price, with the most emotional sizing. Second, it will use downside violence to trigger panic, making you feel like you must exit immediately because something changed, when in reality, nothing changed except liquidity and positioning. The trick is to separate trend signal from noise. Trend signal is structure. Higher shelves holding, curves staying firm, dips being absorbed, the market behaving like it has underlying demand. Noise is the emotional theater. A headline, a one-day flush, a spike in social chatter, the feeling that you must do something right now. So here's the practical defense. Decide your time horizon before the candle prints. If you're a short-term trader, respect your stops and accept that silver will stop you out sometimes even when you are right, so size accordingly. If you're a swing participant, your goal is not to catch every tick. It's to avoid getting forced out by normal volatility. That means not over-leveraging into event windows. It means understanding that a thesis can be correct while price whips violently against you. It means having a plan for both scenarios, pullback retest and continuation squeeze, so you don't improvise under stress. And the next detail is what flips the whole setup. The market doesn't reward conviction, it rewards preparation. Now let S do the concrete what to watch next for the next week or two, because this is where you turn a dramatic story into a usable framework. Watch the $100 behavior like a hawk, not because it's mystical, but because it's where positioning pressure clusters. If price approaches $100 and keeps getting smacked down but rebounds quickly, that suggests demand is persistent, but supply shows up at the headline level. If price breaks through and holds, that's when reflexivity can intensify. Watch the mid-90s zone for absorption. Do dips get bought quickly or do they drift lower with weak bids? Watch the speed of moves. In squeeze conditions, moves up can be fast and moves down can be even faster. Then stabilization appears suddenly. Watch the curve and spreads. If the market is truly relieving pressure, you'll often see the front end relax and the urgency fade. If pressure persists, the curve often stays uncomfortably tight even when price pulls back. Watch positioning headlines with a skeptic's eye, but don't ignore them. When public data shows large exposures and concentration, it doesn't predict direction, but it tells you where forced behavior could come from. And watch the calendar. Month-end flows, roll windows, and macro event risk can cause moves that look irrational but are simply mechanical. Because if this one level breaks, the math changes. Now, let me say the boring thing that keeps you alive. None of this is a guarantee. Markets can reverse for reasons you don't know yet. Liquidity can evaporate. Policy can surprise. A move can overshoot and then mean revert so hard it makes the original move look like a joke. Silver can whip around violently even if the thesis is correct. That's not a disclaimer. That's the nature of the asset. If you treat it like a slow-moving bond, it will punish you. If you treat it like a high volatility instrument and manage risk like an adult, it can be one of the most rewarding macro tells on the board because it sits at the intersection of money and industry. And that's what makes this moment so interesting. Not the number, the mechanism. So here, as the final takeaway, the reason 100 is on the table right now isn't T, because everyone suddenly believes. It's because multiple systems are colliding at the same time. Industrial narratives, macro uncertainty, positioning pressure, and the derivatives reflex that can force buying into thin liquidity. The hidden detail is the calendar and the hedging mechanics. The conflict is it is a blow-off solve story versus the uncomfortable truth that the market S-plumbing can overpower opinion for a window. Your job isn't to worship a target. Your job is to watch behavior. If we get a controlled pullback and a firm retest, that's the market offering a cleaner entry framework. If we get a continuation squeeze through $100, respect the gap risk and don't let adrenaline size your position for you. And if the market breaks shelves and the curve relaxes, respect invalidation instead of arguing with the tape. That's how you stay solvent while everyone else is busy being right on the internet. And if you're still here, you're not here for comfort. You're here for the mechanism. That's the whole edge. Most people want a prediction. You want a process. So here's your subtle community deal. Keep showing up with the checklist mindset, not the headline mindset. Watch the curve, watch the spreads, watch how price behaves around $100 and how it behaves on the first hard dip. Because the next week isn't about what you hope happens. It's about what the market forces participants to do. And once you can see that, silver stops being a casino and starts being a signal.